Are you pondering why mortgage rates seem to be sticking around a bit longer than expected? Well, to find an answer, one must delve into the most recent economic data. This overview will provide a snapshot of the current state of mortgage rates and what the experts predict for the future. Several economic factors can influence mortgage rates. These include the job market, inflation rate, consumer spending, and geopolitical uncertainty, among others. Another significant player is the Federal Reserve, also known as the Fed, and its decisions regarding monetary policy. In early 2022, to slow down the economy and curb inflation, the Fed decided to raise the federal funds rate. This rate determines the cost for banks to borrow money from each other. Though it doesn't directly set mortgage rates, any changes to this rate usually trigger a response in mortgage rates. Consequently, mortgage rates began to rise. While there has been significant progress in reducing inflation since early 2022, it hasn't reached the Fed's target rate of 2%. As the graph indicates, we are closer to the 2% inflation goal than in 2022, but we're not quite there yet. In fact, inflation has slightly increased over the last 3 months, which is influencing the Fed's plans. As Sam Cater, chief economist at Freddie Mac, puts it, strong incoming economic and inflation data has caused the market to reevaluate the path of monetary policy, leading to higher mortgage rates. So in essence, inflation and its impact on the broader economy will play a significant role moving forward. As Greg McBride, chief financial analyst at Bankrate, emphasizes, it's the longer-term outlook for economic growth and inflation that have the greatest bearing on the level and direction of mortgage rates. Inflation, that's really the hub on the wheel. So, when will mortgage rates decline? According to current market data, experts believe inflation will be more under control this year, and the Fed might lower the federal funds rate. However, this may happen later than initially expected. Mike Fratantoni, chief economist at the Mortgage Bankers Association, shared his thoughts on the Federal Open Market Committee decision. The FOMC did not change the federal funds target at its May meeting, as incoming data regarding the strength of the economy and stubbornly high inflation have resulted in a shift in the timing of a first rate cut. We expect mortgage rates to drop later this year, but not as far or as fast as we previously had predicted. In layman's terms, mortgage rates should decrease later this year, but this can change with new employment and economic data, geopolitical uncertainty, and more. Therefore, attempting to time the market is typically not a good strategy. As an article in Bankrate advises, trying to time the market is generally a bad idea. If buying a house is the right move for you now, don't stress about trends or economic outlooks. To summarize, multiple economic factors such as the job market, inflation, consumer spending, and geopolitical uncertainty impact mortgage rates. The Federal Reserve's decisions play a crucial role too. Inflation and its effects on the economy will be key moving forward. While experts predict mortgage rates to decrease later this year, timing the market isn't advisable as many factors can shift these predictions. Remember, if you have questions about what's happening in the housing market and what that means for you, it's always a good idea to seek expert advice.